We have formally entered the event horizon. For months, we warned that the silver marketplace was trading on borrowed time. We warned that the paper rate in New York turned into a fiction, a digital phantasm maintained by algorithms that have been an increasing number of divorced from bodily reality. We warned that once the dam finally broke, the water would not just drift, it might crash. Today, Monday, January 12th, 2026, the dam did not just crack, it disintegrated. Look at the chart. Do not simply glance at it, have a look at it. The price of silver on the Comex touched an all-time high of $84 within the early session. It is presently combating around 82, 79. That is a pass of almost 4% in a single trading consultation. But in case you only have a look at the New York price, you are lacking the unmarried most critical facts point of the day. You are lacking the variety that explains why the banks have lost manipulate. While Wall Street is looking at 82, seeking out resistance, looking for a double top, looking for an excuse to sell, the Shanghai Gold Exchange simply restore the rate of silver at $91.13. Let me repeat that variety due to the fact it is the maximum important range inside the worldwide financial device right now. 91.13. There is now a 7th spread among the fee of silver within the West and the fee of silver inside the East. This is not an arbitrage possibility. This is a structural fracture. This is the bodily marketplace in Asia screaming that the paper marketplace in New York is bankrupt. When you see a gap of this importance, you're witnessing the death of a pricing mechanism. The Comex is making an attempt to tell you silver is worth 82. The physical consumers in Shanghai are paying $91. Who is proper? The market with the paper leverage or the market with the physical shipping? Physics continually wins. The price in New York has to transport up to fulfill Shanghai. It has no desire. If it stays at $82, each trader on the planet will buy in New York and promote in Shanghai until the vaults in the West are empty. This is the mechanism that forces the squeeze. So allow us dissect the charge motion we noticed this morning. We opened the consultation at $80.69. We dipped to a low of $79.95, and then the vacuum opened. The charge teleported to 84. This vertical circulate is exactly what we noticed inside the nickel marketplace in March of 2022. Do you take into account that? A huge industrial brief vendor got stuck on the wrong facet of a geopolitical shift. The charge went vertical. The exchange broke. The trades were canceled. We are seeing the early ranges of that precise equal pattern in silver. The vertical inexperienced line on latest chart is a criminal offense scene. It is the footprint of a compelled client. Somewhere within the plumbing of the monetary system, a large entity, in all likelihood, a bullion bank or a chief commercial hedging fund, ran out of collateral. They were quick at $75. When the Shanghai rate hit 91, their risk model blew up. The clearing residence computer took over and hit the market buy order. It offered at 81, it bought at 82, it sold at 83. It did now not prevent buying till it hit 84. But we have to continue to be rational in the face of this volatility. If you look carefully at present day candle, you notice a wick at the pinnacle. The charge hit $84 and changed and pushed back off to 82. 79. The mainstream media will tell you that is a rejection. They will let you know the rally is over. They will tell you that clever money is taking earnings. They are mendacity to you. That wick is not income-taking acting. That wick is desperation. It represents the remaining stand of the ultimate short sellers. They are protecting the 85 degree with their lives due to the fact they recognize that if silver closes above 85 and follows, whilst Shanghai is at 91, the sport is over. They end up bankrupt. So they are throwing each paper agreement they have on the marketplace. They are selling futures they do not have. They are looking to paint the chart red to scare you out of your function. But look at the result. Despite their most attempt, regardless of the huge extent of selling, the candle remains green. The fashion remains up. The lows are becoming higher. This confirms that the suppression algorithm is broken. In December, after they spoil the price, it stayed down for every week. Today, they spoil the price and it bounces again in an hour. The law of diminishing returns has hit the manipulation desk. We need to speak approximately the Monday morning hole. Gapping up via an all-time high on a Monday is a completely precise technical signal. It mattered the news, the Shanghai fee, the industrial shortages accumulated over the weekend, the pressure constructed up at the same time as the markets have been closed. And the instant the bell rang, the strain launched. This creates a psychological crisis for anybody who is sitting in cash. If you're looking forward to a pull back to 75 to buy, you are now understanding that pullback would possibly by no means come. You're looking at 83 and feeling the concern of lacking out. This worry is what drives the subsequent leg of the rally. It is known as a chase. Funds that are underweight silver are compelled to chase the charge better due to the fact they cannot have enough money to underperform the benchmark. But I want to give you a caution. In a vertical market, volatility is the weapon of desire for the banks. They can't forestall the charge from going up, but they could make the trip extraordinarily painful. It is relatively possibly that we see a flush later this week. They would possibly control to drive the price back down to test $79. If you see silver drop 5 the next day, do now not panic. Do not sell your bodily metal. A drop to 79 could sincerely be a back check of the breakout stage. It is the market checking to peer. If the floor is solid, it's far healthful, it's far regular. However, given the Shanghai top rate of $7, there is a totally real opportunity that the again check never happens. We might simply keep going, and we would see restriction up days, where the exchange halts trading due to the fact the fee is moving too fast, or you need to alternate your attitude. You're now not trading a variety, you're surviving a currency reset. When you spot silver at 84, do not suppose silver is highly priced. Think the greenback is damaged. You're looking the purchasing power of the fiat foreign money evaporate in real time. The chart of silver is just the inverse chart of the dollar's credibility. And right now, with Shanghai paying $91, the credibility of the Comex pricing mechanism is 0. The disconnect between the display screen price and the street rate is now plain. If you call a provider these days to shop for silver eagles, they'll now not promote them to you at 83. They'll rate you 100, or they'll inform you they're out of inventory. This is what a physical default seems like. The price at the display is for paper. The charge on the street is for metal, and the unfold among them is widening each single day. So, as we near out this first part of the analysis, the technical verdict is apparent. The trend has changed from accumulation to vertical liquidation. We have damaged the 80 ceiling, we have touched $84, and we have a large magnet at $91 pulling us better. The banks are preventing a dropping war. They are trying to maintain a seashore ball underwater with a toothpick. They might win a few minutes of fee motion. They may paint a red candle on the hourly chart. But the physics of the marketplace, the arbitrage among East and West, is relentless. In the subsequent phase of this deep dive, we are going to have a look at the industrial panic. We are going to give an explanation for why groups like Samsung and Tesla do now not care approximately the price. They care about deliver, and we're going to reveal you why their panic buying creates a floor under the fee that no banker can spoil through. The paper recreation ended on Sunday night. The bodily game commenced on Monday morning, and the rating is currently Shanghai 91, New York 82. The gap need to near, and it'll near the upside. While the algorithms in New York have been combating over the price of a paper contract, a very special and plenty extra terrifying communique became occurring within the boardrooms of the arena's biggest production conglomerates. We have spoken at duration about the paper sport as opposed to the physics recreation. Today, on January 12th, the gamers of the physics recreation just flipped the table. To apprehend why silver isn't always crashing return to $60, why the 84 degree is appearing as a magnet in preference to a ceiling. You ought to position yourself in the footwear of a procurement officer at Samsung SDI or Tesla. You aren't a day trader. You do not care approximately Fibonacci retracements or transferring averages. You have one process. Ensure that the meeting line does no longer forestall. We know from our previous investigations that Samsung has committed billions of greenbacks to the mass manufacturing of solid-state batteries. These batteries utilize a silver-carbon nanocomposite anode. This isn't a principle. This is the chemistry of the future. The factories are constructed. The tooling is established. The deliver contracts are signed. But right here is the trouble that arose this weekend. The contracts have been signed based totally on the idea of to-be-had supply. They assumed that the London vaults had metallic. They assumed that the Comex should supply. When the charge gap opened on Sunday night time, and while Shanghai fixed the fee at 91.13. This morning, the one's assumptions evaporated. Imagine you're the Samsung government in price of sourcing silver. You see the Shanghai price at 91. You see the New York rate at $82. You realize, because you apprehend logistics, that each ounce of unallocated silver on the earth is presently flowing towards Shanghai to capture that 7 arbitrage profit. The metallic is moving east. It is leaving the Western Hemisphere. If you do now not act without delay, in case you do not bid higher than $82,000, your manufacturing facility in South Korea or Nevada runs out of uncooked fabric. If the factory runs out of silver, the meeting line halts. If the road halts, you miss your transport goals for the brand new EV fleets. If you miss those objectives, your inventory price crashes, and also you lose marketplace proportion to the Chinese competitors, who, allows be sincere, already secured their silver reserves years ago. So what do? Do you anticipate the fee to dip? Do you desire the chart seems better the next day? No. You panic buy. You select up the telephone, and also you name the mining companies without delay in Mexico and Peru. You inform them, forget the conks, forget the London fix. We can pay you $85 in Oz right now coins if you deliver the concentrate at once to our refinery. This is what we call ghost deliver. It is metal that bypasses the general public alternate totally. It never touches the Comex warehouses. It creates a vacuum in the visible stock. To the public, it looks like deliver is simply disappearing, but in fact, it's miles being privatized through commercial giants who are frightened of a scarcity. This creates a phenomenon known as rate inelasticity. The mainstream media analysts, the ones who instructed you silver became a bubble at $50, they perform on the assumption that as fee goes up, demand is going down. That is authentic for luxury goods. If a designer handbag doubles in rate, you buy fewer purses. But silver isn't a handbag. It is a strategic factor. Let's run the maths on a strong nation battery. Suppose there are 50 G of silver in the excessive overall performance battery percent. At $60 in Oz, that is kind of $100 of silver in line with automobile. At $84 in Oz, that is more or less $135 of silver in keeping with car. Does a $35 boom within the cost of substances stop a person from shopping for a $50,000 electric car? No, it is a rounding blunders. The automobile company can effortlessly take in that cost or bypass it directly to the customer. But, and that is the critical factor, they cannot construct the car without the silver. So demand does now not drop whilst the price hits $84. In reality, call for might virtually boom. Why? Because the fear of unavailability outweighs the pain of the higher fee. Samsung could instead pay $100 in Oz and feature the metal than pay $80 in Oz and feature the line close down. This commercial panic is the floor beneath the market. The banks can play all of the paper video games they want. They can brief tens of millions of Oz at the futures market to try to smash the price, but they cannot print bodily silver bars for Samsung. Samsung wishes atoms. Tesla wishes atoms. The sun panel producers in Germany want atoms. And right now, the atoms are going to the very best bidder. And the best bidder is presently the Shanghai Gold Exchange at 91. 13. This efficaciously places a put alternative under the price of silver. It means that if the price drops to 78, the commercial consumers will step in and scoop up each unmarried ounce due to the fact to them it is a discount on an important survival fabric. We are witnessing the industrialization of silver's economic top class. For hundreds of years, silver became cash. Then for 100 years, it changed into a commercial commodity. Now it's far both. It is a monetary asset being squeezed by an industrial necessity. And we haven't even mentioned the army attitude, but look on the headlines from the last 2 weeks. The geopolitical temperature is rising. The U.S. Army operation in Venezuela on January 3rd required massive logistical help. Modern battle is digital warfare. Every missile, every drone, every satellite TV for PC, each communication array requires silver. It is the maximum conductive metal inside the universe. You cannot combat a high-tech struggle without it. The U.S. Department of Defense does not have a strategic stockpile of silver. They bought all of it decades ago. If the struggle expands, the Pentagon turns into any other inelastic purchaser. Do you observe the USA military cares if silver is $84 or $184? No. They print the cash. They pays whatever it takes to secure the steering chips for their missiles. So you have got Samsung fighting Tesla, fighting the Pentagon, preventing the Reserve Bank of India, preventing the Chinese speculators. All of them are chasing the identical shrinking pile of physical metallic. And in the middle of this brawl, you have got the industrial banks at the Comex retaining a naked quick roll, praying that the rate drops so they don't move bankrupt. It is a suicide task for the banks. They are standing on the tracks trying to stop a freight train with a chunk of paper. This brings us to the refinery bottleneck. This is a detail that is often omitted, but it is important to the activities of January 12th. Even if there may be silver popping out of the ground, and remember, mine supply has been flat or falling for years, it needs to be delicate. It needs to be turned from raw door bars into the 999 nice commercial bars that Samsung calls for. Refineries have a most ability. You cannot simply flip a dial and refine more metal. It takes time. It takes power. We are hearing rumors, and I emphasize these are currently rumors, however they fit the records, that primary refineries in Switzerland and Canada are completely booked for the next 6 months. They are jogging 24/7 shifts. They cannot manner any extra metallic. This approach that, although the rate goes to $2.100, there may be a pace restriction on how rapid new supply can enter the marketplace. The pipe is clogged. So while we see an opening as much as $84 on a Monday morning, it's miles the marketplace pricing in this bottleneck. It is the marketplace figuring out that instantaneous silver is really worth a lot extra than future silver. This is referred to as backwardation. It is while the spot charge is higher than the futures fee. It is the remaining signal of a bodily scarcity. It means buyers are willing to pay a top class to have the steel now in place of weight for transport next month. Why? Because they don't believe that the steel may be there next month. They agree within the simply-in-time delivery machine has shattered. For 40 years, international supply chains operated on performance. You didn't preserve inventory. You just ordered it whilst you needed it. That technology died these days. We are entering the era of just in case. Companies are going to start hoarding. They are going to build stockpiles. Instead of keeping weeks of silver inventory, Samsung might determine to hold 6 months of stock. If each predominant electronics manufacturer comes to a decision to triple their stock buffer, international demand doesn't go up by 5%. It doubles in a single day. That is the call for shock we're living through. It is in stock rebuilding cycle within the face of a currency disaster. So when you have a look at the chart and spot the volatility, whilst you see the fee whip from 84 to 82 and back to 83, do no longer get dizzy. Look through the noise. See the procurement officer sweating in his workplace in Seoul. See the military logistics commander shouting at his providers in Washington. See the refinery supervisor in Switzerland telling his clients that there's a 6-month wait list. That is the fact. The chart is simply the shadow of that reality. The banks want you to suppose this is a bubble. They want you to think it's far speculation. They need you to promote your silver so that it will cover their shorts and ship the metallic to Samsung. Do now not be their liquidity. The commercial ground is strong. The geopolitical floor is strong. The financial floor is solid. 84 isn't always the top. 84 is the panic button. And the panic is simply getting began. In the next part of this deep dive, we're going to have a look at the retail tsunami. We have mentioned the whales, the banks, and the industry. But what takes place while the common character, the primary avenue investor, wakes up to this news? Google Trace records suggest that searches for how to shop for silver exploded over the weekend. The public is arriving. And while the general public arrives, the bodily shelves go empty in ours. We are going to analyze the dealer marketplace, the charges, and why the unobtainium section is the following logical step in this series. The industry is buying because they ought to. The public is about to buy because they need to. And the banks are approximately to realize that they may be on the wrong facet of records. The smart money moves in silence. The commercial money movements in desperation. But the public cash actions in a stampede. In Component 1 and 2, we dissected how the whales, the primary banks, and the manufacturing giants have cornered the market. They operated quietly behind the curtain, draining the wholesale vaults even as the rate becomes suppressed. They sold the dip. They bought the consolidation. But these days, the secret's out. The 10% circulate over the past 2 trading periods turned into a flare gun fired into the night sky. The average person who has not looked at the charge of silver given that 2011 just seamed up, and what they see is a rocket deliver. We are witnessing the beginning of the retail tsunami. This is the phase in which the psychology shifts from is silver an excellent funding to how do I get silver earlier than it runs out. Look at the leading indicators. We aren't speak me about technical charts anymore. We are speak me about human behavior. Over the weekend, worldwide search volume for the phrase how to buy silver spiked via over 300%. Social media lights up. The narrative is transferring from silver is a dead rock to silver is the brand new Bitcoin. This narrative shift is dangerous for the banks because the retail crowd is price insensitive. When a hedge fund supervisor buys, he calculates fee. When a retail investor buys throughout a mania, he buys momentum. He sees the rate pass from $80 to $84 and his brain screams, I am missing out. So he logs into his brokerage account. He drives to his local coin shop. He brings a wave of capital that does not care approximately resistance ranges. But here's the trouble. The pipe is just too small. The retail silver marketplace, the market for cash, small bars and rounds, is a tiny fraction of the general marketplace. It is the top of the iceberg. The enormous majority of silver is in 1,000 commercial bars. When Samsung and Tesla vacuum up the 1,000 bars to construct batteries, there is no metal left for the private mints to turn into coins. The feedstock for the retail marketplace evaporates. We are already seeing the signs and symptoms of a bodily breakdown at the provider stage. I checked the stock of 3 predominant online bullion dealers this morning. The message is the equal. Delayed delivery, high quantity alert, and in a few cases, the most terrifying word a consumer can see. Call for pricing. Why do they are saying call for pricing? Because the volatility is so severe that their automatic pricing software can't preserve up. If they promote you a coin at $85 and the fee gaps to $90 within the subsequent 5 mins, they lose money. So they turn off the purchase button. They freeze income. This creates a phenomenon referred to as unobtainium. The price on the display may say $82, $79. However, try to buy an ounce of silver for $82. You can't. The sellers are charging premiums of $15, $20, even $25 over spot. This manner, the street charge, or the actual fee you pay to maintain steel on your hand, has already crossed the $100 barrier. The disconnect is whole. We have two markets now. We have the paper market on the Comex, where banks change digital contracts backward and forward to set a fake price. And we have the bodily marketplace on the road, in which actual steel trades at a large top rate due to the fact there is not sufficient to head round. This brings us to the most risky trap for the brand new retail investor, the ETF lure. When the public receives excited about silver, maximum of them do no longer buy bodily metallic. It is just too difficult. You have to shop it. You must pay for delivery. So they open their stock trading app and that they purchase an ETF like SLV. They suppose they're assisting the squeeze. They think they're buying silver. They are incorrect. Buying a paper ETF during a physical scarcity is like buying a price tag to a concert this is already burned down. You have the ticket, but there's no show. The legal individuals of these ETFs are often the identical bullion banks, which can bebrief the market. When you pour billions of greenbacks into the ETF, you are basically handing your cash to the very entities that are fighting against you. They use the shape of the fund to find metal, rent it, and rehypothecate it to suppress the fee. Do no longer be their liquidity. If you cannot preserve it, you do no longer personal it. This mantra has in no way been more vital than its far on January 12th, 2026. The RBI understands this. That is why they offered physical gold, now not a gold ETF. The Chinese industrial consumers understand this. That is why they are taking shipping of bodily silver in Shanghai. The retail investor wishes to examine this lesson speedy, or they'll be the bag holder of a broken promise. So, what happens subsequent within the retail area? As the news of the shortage spreads, the panic will boost up. We will possibly see strains forming out of doors, coin stores. We will see transport delays stretch from 2 weeks to 2 months. We will see the premiums expand till the paper charge becomes irrelevant. This places the Comex in a not possible function. If the street charge is 110, the Comex price is 82. Any dealer with a warehouse receipt will stand for delivery. They will take the metallic out of the Comex at $82 and promote it on the street for 110. This is the arbitrage that kills the alternate. It drains the Comex vaults until they hit zero, and we know the vaults are already bleeding. The registered category, the silver this is truly available for shipping, has been dropping for years. It is at historic lows. The 10% move we saw this week is the marketplace sniffing out the lowest of the barrel. It is the conclusion that at 80, there is no metal left. So the charge has to visit 90. If there may be no metallic at 90, it is going to 100. It continues going till a person someplace is willing to sell their family silver. But who's selling? Are you selling? I doubt it. You have held via the bear marketplace. You know the fundamentals. You realize approximately the Samsung battery. You recognize about the debt. You aren't going to sell your coverage policy simply due to the fact the house stuck hearth. You're going to preserve it tighter. So you have got a market with massive new demand from enterprise, panic shopping from retail, and a legacy holder base that refuses to sell. This is the recipe for a vertical melt-up. But I ought to repeat the caution from element 1. Do no longer use leverage. The banks understand the retail crowd is here. They recognize the new shoppers are emotional. They know they may be overextended. They will try to wash you out. They will engineer a flash crash. They may drop the rate 10 and 10 mins at some stage in a low liquidity period, just to cause your forestall losses. If you are trading on margin, you will be worn out. You will be proper approximately the direction, but you will lose your account before the destination. If you personal physical steal, a flash crash means not anything. It is simply noise. Your ounce of silver is still an ounce of silver. It still conducts electricity. It nevertheless stores price. It remains outside the banking system. The retail tsunami is the very last wave. The clever cash came first. The commercial cash came second. The public cash is arriving now. When the general public arrives, the volatility explodes. We are going to look days where silver actions $5, $10, perhaps even $15. The stages are expanding. The stability is long gone. We are entering the mania phase. In the very last part of this deep dive, we are going to map out the cease recreation. We are going to observe the 3-digit goals. We are going to discuss the possibility of a Forex reset, wherein gold and silver are formally revalued to extinguish the sovereign debt. And I'm going to give you the exit method because ultimately each mania ends. Eventually you may need to alternate your silver for land for coins flowing assets for freedom. But now not yet. The party is just beginning. The song is playing and the banks are the most effective ones without a chair. The retail tsunami has made landfall. Hold speedy. We have arrived at the conclusion. If you've been with me through this complete deep dive, you presently recognize the full anatomy of the breakdown. You apprehend the technical breakout at 84. You apprehend the economic panic using the ghost deliver. You recognize the retail tsunami that is currently draining the supplier community. Now, we need to look ahead. We should map out the territory that lies beforehand. Because once an asset breaks its all-time high, once it enters price discovery, there are no maps. There aren't any resistance degrees at the chart because we've never been here earlier than we are flying into the vacuum. So wherein does this prevent? Is 84 the pinnacle? Is $100 a top? To solution that, we cannot observe the greenback rate. As we've installed, the greenback is a damaged backyard stick. Measuring silver in dollars is like measuring the duration of a bridge with a rubber band. The rubber band is stretching, so the bridge seems longer. Instead, we should have a look at relative price. We must look at the connection among the two economic metals, gold and silver. Look at the rate of gold these days. It is buying and selling around $580. It is protecting corporation. It is the anchor of the new financial device. Now, let's study the gold to silver ratio. Throughout monetary history, from the Roman Empire to America Constitution, the herbal ratio of gold to silver changed into more or less 15.1. For each 15 ounces of silver inside the earth, there was 1 Ozof gold. In the cutting edge era, that ratio blew out. It went to 80, 90, even 100 to a 1. This turned into a sign of severe suppression. It meant silver was being priced as a cheap commercial byproduct, not a scarce financial asset. But today, with gold at $580 and silver at 82, the ratio is approximately 55.1. The ratio is collapsing. It is reverting to the suggest. If silver were to actually go back to its ancient monetary norm of 15 to 1 against the current fee of gold, wherein would it not be? Do the math. 45 out of 80, 15 equals $35 in step with ounce. $35. It is on sale. It is trading at a 70% bargain to its economic parity. This is the capture-up alternate. Algorithms realize this. Central banks recognize this. When gold gets too highly priced, capital flows into silver due to the fact it's miles the negative guy's gold. It offers extra leverage. It offers extra upside. This is why I believe the circulate to A100 is not a query of if, but while. The Shanghai fee is already at $91. The street fee is already over $100. The paper rate has no choice, however, to follow. $100 is the psychological barrier. Human beings love spherical numbers. When silver crosses $100, it'll trigger an international media frenzy. It could be on the cover of Time mag. It might be the lead story on the nightly information. That is the moment of maximum risk and maximum possibility. This brings us to the exit method. Don't wisp. I understand a lot of you're thinking about selling. You examine your stack. You calculate the fee in dollars, and also you feel wealthy. You think, I will pay off my residence. I can purchase a brand new automobile. But you need to be very, very cautious. If you sell your silver for greenbacks, what are you clearly doing? You're trading a hard asset. This is appreciating for a gentle currency that is collapsing. You're jumping off the lifeboat and swimming again to the Titanic due to the fact the Titanic has a minibar. The greenback isn't the destination. The greenback is the sufferer. We are residing through a foreign money reset. The $50 billion bond sale through the Reserve Bank of India changed into the signal that the sovereign debt bubble is turning. When debt bubbles pop, currencies die. In every currency disintegrate in records, from Weimar Germany to Zimbabwe to Venezuela, people who offered their gold and silver too early regretted it. They bought for tens of millions of paper gadgets, most effective to discover that a loaf of bread fee billions of paper devices a month later. So whilst do you promote? You sell when you could alternate your Oz for income-rousing, difficult assets. This is the Oz to acres method. Do no longer trade your silver for paper, trade it for land, trade it for apartment belongings, trade it for enterprise, trade it for energy infrastructure. Wait for the instant whilst the mania is so high that real property costs have crashed relative to silver. Right now, it'd take 5,000 Oz of silver to buy a decent house. In the height of a mania, it might take 500 ounces. That is the exchange. You are swapping one shape of generational wealth for every other form of generational wealth. You're bypassing the fiat foreign money, absolutely. But we are not there. But we are at $82. We are just leaving the launch pad. The week ahead goes to be the longest week of your monetary existence. The volatility can be nauseating. The banks will release counterattacks. They will attempt to ruin the rate all the way down to $75 to trigger prevent losses. They will spread rumors of a ceasefire or a bailout to try and calm the marketplace. Ignore the noise. Watch the flows. Is the Reserve Bank of India buying bonds again? No. Is Samsung preventing its battery manufacturing? No. Is the Shanghai premium disappearing? No. The basics are locked in. The bridge is burning behind us. There's no going return to $20 silver. That world is long past. We are entering the era of resource nationalism. Countries which have silver, like Mexico and Peru, are going to start hoarding it. Countries that want silver, like the US and China, are going to fight for it. You, the individual investor, are standing inside the middle of this geopolitical brawl, holding the only issue everybody needs. Do now not let them shake you free. Hold your role. Secure your vault. Educate your family. The notable repricing is not pretty much getting rich. It is about surviving the transition from a debt-primarily based economic system to a resource-based, totally economic system. The greenback died on Sunday. The price discovery started out on Monday. And the future belongs to folks that keep the physical reality in their hands. Stay secure, stay liquid. And welcome to the age of actual money.